So this article is talking about basically is that in the crypto space, if cryptocurrencies and the cryptocurrency exchanges are going to be regulated like commodities, if they're not able to show proof that they can make a delivery of goods. So, for example, the way that I read this article was, and again, this isn't financial advice or investment advice. This is part 2 of what I'm talking about when it comes to Bitcoin bubbles and investing in a Bitcoin bubble. This is, my take on this, and this is how I'm applying it to my investments. And so, this give you an example of this. It's a Bitcoin contract, or Bitcoin will be considered a futures contract if delivery's not able to, if proof of delivery's not, if the exchange cannot prove that they can make delivery. For example, on the futures markets, they sell, gas, or they sell oil. Those exchanges don't necessarily own the oil today to send to you when you buy it. Ironically enough, the futures, I'm thinking, but this isn't a problem for Bitcoin exchanges, because when you buy Bitcoin through an exchange or trade Bitcoin through an exchange, you can absolutely send it to your wallet. Any other cryptocurrency, you can send to your wallet in just most cases a matter of a few minutes at most. I'm like, this isn't a problem, except they've already went after, in this article, they talk about they've already went after, I think it was Bitfinex. Oh, here it is. The commission regulates retail commodities transactions with the exception of contracts of sales that result in actual delivery within 28 days. Bitfinex, which is one of the largest crypto exchanges, was sanctioned by the commission last year. This was not new news. The CTFC explained that the exchange did not adhere to the regulations and did not supply the purchased digital currencies to buyers within the stipulated time period. According to CTFC, Bitfinex held the purchased Bitcoins in Bitcoin deposit wallets that it owned and controlled. So they're saying because they owned and controlled the wallet, this is so ridiculous. Because they own and control the wallet, even though you could send it to your own electronic wallet, which is nothing more than an electronic transfer from one electronic location to another electronic location, on the blockchain, basically, that because they weren't transferring it out. So then therefore it was a futures contract. This is an example of laws not staying up to date, and this is extremely common in the workplace of business. I mean, this is extremely common. So, by the way, no different than, some of the ways that they stop online gambling sites and sports books especially were using old school racketeering laws that did not even apply to the current market when they were set up. Governments do this all the time. So this could be a problem potentially, for sure. It depends on how this gets interpreted for by the regulators. And they most likely are not going to be super friendly to this space. And it's because big money basically controls the CFTC. And so these regulators, the board of the regulators, the people who sit on the regulators, a lot of times they come from big finance anyway. So, there's a bit of a conflict in interest of them, trying to do what's right to protect citizens, but at the same time, protect themselves and their cronies in some cases as well. I hate to see the split in the cryptocurrency space because people want to, bash each other coins. They need to be standing together because at the end of the day, I mean, governments are going to come in, and as a group, we need to let our voices be heard to potentially prevent as much of this regulation as possible. And at the very least, we all need to be paying attention to it and be aware of it. Again, I'm not anti-regulation, but I don't like seeing the free market I don't like people having access cut off. Yes, bad companies should not be allowed to do bad things, but there's no situation where we're going to create an environment where nothing bad will ever happen. And I believe we do more bad if we're not careful. So this kind of stuff can lead to a potential bubble. People lose access. People get nervous about what other regulations are coming down. Maybe I shouldn't be in, cryptocurrencies right now, and they start selling. If you know me, you know that I don't get too caught up with the whole bubble thing. There's a few rules I follow. First of all, your cryptocurrency needs to, hold on, I'll show you. Your your cryptocurrency investments need to start out. If you're like me, I started out with money that I could afford to lose. A few $100, a few $1,000. Maybe for some of you, it's, a few $10,000 or something. I don't know. Maybe it's $50. Start small. I will tell you, as those regulations come into effect, smaller investors are not going to be allowed in many cases, just because the regulations require minimum account sizes and stuff like that. I think to open a futures account with most brokerages, you need $2,500 or $5,000 anyway. Maybe it's as much as $10,000 in some cases. So that kind of stuff is most likely to be coming down the pipeline. And the reason they put that in place is because they want to prevent you from being part of the market, you and me from being part of the market if we can't afford to be a part of it. And it's not necessarily a bad thing. It's meant as a protection. But at the same time, I think that it also cuts off the market from people who, listen, why shouldn't you be allowed to be a part of the market? If you have an extra $50 or $100 or $200 you want to invest in Bitcoin, you should be able to do that, in my opinion. But what do I know? We just have to operate in this world. We don't get to control it. However, you should never invest money you can't afford to potentially lose. It's highly speculative in place. It's an exciting place to be a part of. It's been getting mega returns, but it doesn't mean that the music's going to go on forever. Long term, you're investing for the long term. If you're not willing to invest, and I know this sounds crazy because the market goes up so much. If you're not willing to invest and see a return on your investment in the next 5 or 10 years, then you shouldn't be investing in the first place. If you need that money, you shouldn't be investing. So that's the first rule. Only make this your most speculative part of your portfolio. If you don't have any other investments, you probably shouldn't be in the crypto space, to be honest with you. That's the first rule. Second rule is make certain that there's a use case for your coins. Now, this is going to be so unpopular right now, but this is one of the things that kind of bugs me a tiny bit about this whole space. Let's see. So, make certain there's a use case for your coins. For example, Bitcoin, potential currency. That's the primary reason for Bitcoin. That's the reason it was created. Electronic, decentralized, mobile currency in a trustless environment where anyone can see third-party verification. Transparent environment. Number one reason for it. Ethereum, similar to Bitcoin, however, programmable with smart contracts. You need Ethereum to be able to work with those smart contracts. Bitcoin Cash, similar use case to Bitcoin. Ripple. You do not need Ripple. There is no need to have this currency. It does not have to exist. The underlying technology is 100% independent of this Ripple. This is so unpopular right now, but it's the truth. People are buying into this because the owners of the technology own a lot of Ripple. They sold Ripple to raise money, probably through an ICO of some sort. And therefore, it only has value because the market gives it value. But you don't need, the technology is independent of it. If you're going to use cryptocurrency and you're going to choose to use Bitcoin as a currency, Ripple is not, its main focus is not to become a currency. Litecoin, its main focus is to become a currency, an alternative to Bitcoin and Bitcoin Cash. It has features that make it a little bit better depending on your opinion of the market. IOTA, similar to Ethereum, operates differently though. It's a competitor to Ethereum. You need IOTA. You have to have IOTA to use this technology. Same thing for Cardano. Same thing for Dash. I think so for Neum, EOS, yes. Monero, yes. Bitcoin. Now, as you start getting down here, Neo, yes. Ethereum Classic, yes. Amise Go. You do not need this cryptocurrency for the technology of Amise Go. They sold this cryptocurrency to ultimately raise money. This is where regulators are going to possibly come down hard, and these are the currencies I think that long term could be soft. When you need the technology, even BitConnect, people love to hate on BitConnect. It blows my mind. However, in some ways, BitConnect, at least there's a stronger use case for that coin than there is for Amise Go. You have to have BitConnect coins to participate in the platform. BitConnect in some ways is better than Amise Go from a use case perspective. I'm not super familiar with Populous. Zcash, yes. Waze, yes. So as you come down here, Walton Coin comes to mind. That's one that's been in the market. As you come down, make sure Walton Coin. I want to talk about this one. Walton Coin and VeChain. Both of these are super cool technologies, and I believe RFID is the way of the future. Super cool technologies, and if you're investing in those coins, that's great. Just understand that those coins are not needed for the technology. It's almost like they sold a stock without giving you potential ownership of the company. That's crazy if you stop and think about it. This is so unpopular in this space, and it's so unpopular for a YouTuber, but make certain that, first of all, you're only investing money that you could potentially afford to lose. Second of all, that the coins that you're investing in have some sort of use case. Like, you have to have the coin. Cannot exist without the technology, and the technology can't exist without the coin. That's what you're ultimately looking for, some sort of use case in practice, in principle, between the coin and the technology. The other thing is diversify. First, diversify in this space. You own multiple cryptos, great. You own, investment platforms, great. You own mining, great. Whatever, just diversify. Now, that's the third one. The fourth one is this. Look for markets that give you a return. This is where I like BitConnect. This is where I like Genesis Mining, even Hashflare. I love to see people poo-poo cloud mining. It just shows that they simply do not understand the benefits of cloud mining. Some people even poo-poo hardware mining. They simply just don't understand. They all have their place. Again, why there has to be all this hate in this space is beyond me. Mining, investment platforms, masternodes, Pivx, Dash. There's even smaller coins with masternodes. People love to get up, people like to say, well, this coin was created just because it was cheap. Masternodes, it's a scammy coin, blah, blah, blah. Let the market determine what a scammy coin is. But at the end of the day, at least if there's a masternode, at least they provide some use case for the coin. At least the coin has to be necessary to maintain masternodes. The coin has to be necessary to maintain the network. At least make certain that at least that creates some sort of a use case for the coin. However, at least masternodes, if you own a masternode, that produces some sort of income. Here's why income is important, or some sort of cryptocurrency income, cryptocurrency asset trade-off, meaning they're giving you a percentage of cryptocurrency. They're giving you some free cryptocurrency every month. It's because when you have those types of investments, what that does is it helps decrease your risk because you're getting something back. When you're just holding Bitcoin goes up or down. You get nothing for it. But when they give you more Bitcoin, you can choose to sell that Bitcoin. It gives you options when you're mining, for example, if you're getting a return on your mining, then you're taking your mining, you're able to take your money, invest in mining, get your money back in Bitcoin, get your Bitcoin back that you would have bought, essentially, and earn further Bitcoin that you can sell for cash if you want. That decreases your risk. If you have $100 with mining and you can sell $10 worth of Bitcoin, then you got $10 back. Now you only have $90 in mining. Same thing with, BitConnect. If you invest in BitConnect and you get a payout, in my last video I was talking about the safest BitConnect strategy, and I'm still going to, by the way, when I get back home here in a few days, I had a family emergency, so I'm traveling, but when I get back home in a few days, I'm going to be talking about some more BitConnect investment strategies. But at least on those strategies, when you're pulling money out, the name of the game is how to decrease your risk. So only invest money that you can afford to lose. As your investments grow, as it starts to become a more important amount of money, you start getting, what's important to you. This is how I do it. When I get to, $5,000 and $10,000, $3,000, $2,000, I consider, diversifying a little bit. The more money I have, the more I diversify. I do think you can over diversify. But as you start diversifying, invest money you can afford to lose, diversify along the way, make certain there's a use case for your coin, and last but not least, always look to get a return on your coin if those are the coins that are going to potentially hold up if there is a bubble. And the last thing is, get outside of the cryptocurrency space with some of your markets, with some of your money. You make money in this space. This is a speculative investment. If you start making a lot of money in the crypto space, start going into real estate. By the way, I do the exact opposite. I do real estate first, cryptocurrency next. But put money back into real estate. Put money into gold and silver. Invest in the traditional stock market. I've done so well in things like the dividend markets. I've done very well over the years in the dividend markets. So diversify inside the space and then outside the space. Thank you for watching. This has been my second part.